target investor wants. And so, in that direction, we move on to the investor profile. You can go to the next slide. Now, the information which was provided to us, the fact that the individual, Mrs. Savita Nair, the information which was given to us was the fact that she is 40 years old, her current income, the investment avenue was strictly mentioned as only mutual funds, nothing else. And the current lump sum investment of 1 lakh. Now, based on her age, which is 40, so basically we looked at was the fact that when you are a 20-year-old, you go for an aggressive portfolio. At the same time, when you are a 60-year-old, you want protection of capital, you want regular income from your investments. So when you consider that for a 40-year-old, you look for a balance approach, a 50-50 approach. But the reason we go for a moderately aggressive, which basically says that 60% equity portfolio to 40% debt portfolio. The reason for that is India is poised for growth. The next decade is going to ensure that India is a developed economy. And for that reason, we consider the risk profile as moderately aggressive. Now, the possible goals which we envision would be the fact that the current lump sum investment would be required at the age of 60, which is when she retires. So obviously, you're looking at a retirement fund. Then you're looking at staff education and annual vacations, which is a growing trend in our economy. Moving on to the next process, on any financial planning process, what we've done is we have defined the situation, we have developed the kind of goals which is retirement, we have looked at the course of action. Now the course of action has been specified as only investments in mutual funds, and that is the course of action. Now comes the most important part of the process, which is evaluating the alternatives. This is deciding which mutual funds, what exactly is the kind of returns we can actually get out of this, and evaluating from the many options out there. And moving on to the next one. Now, the kind of mutual funds that we've decided to go for has been sectoral funds. Now, obviously, funds which invest in a particular sector, say the FMCG, the power sector, the infrastructure fund, and these funds are extremely risky. At the same time, considering the risk, these are also high return investments. Then you have the diversified equity funds. Now, these funds invest in large caps, and these are some of the most famous funds out there. So this is the relatively safe one. Then you have small and mid caps. Now small cap and mid cap stocks are the ones who are in a startup stage. These companies can actually use explosive returns which can range from 150. They can also go down minus 150. So in that approach, we're taking the small cap and mid cap ones. Then we have debt and arbitrage funds. Obviously, every ship needs an anchor. And this is the kind of stability we are intending to provide by investing in debt and arbitrage funds. The commodities and metal funds is something I'll elaborate in the slide. Okay, now the sectoral funds, pick up the sectors which are most likely to grow. When a nation grows, the first thing is people start consuming more. So you've got the FMCG fund. Now, as you consume more, you need more power to build factories. Obviously, power consumption increases. So Reliance Diversified Power Sector Fund, which is one of the best performing funds all over the world, not only in India. Then you have the banking fund, which banking is an obvious area of growth when an economy grows. And then you've got infrastructure, which is obviously what India needs desperately. Next slide. Now, the DSP, the diversified equity funds are relatively safe funds, which everyone knows about. The HDFC Top 200, Frontline, Growth, DSP BlackRock, these are proven funds. And I believe I do not need to elaborate on this. The small and mid cap funds. Now, obviously, this is where we are looking at growth. Alright, this is something that can give a portfolio the aggressive push that is required. HDFC Mid-Cap, Micro-Cap, Discovery, and the SBI Micro Emerging Funds are the top performing funds who have given 200% returns till date. And we believe that it will continue in the future as well. The next slide. Now, the debt and liquid fund. Obviously, now about providing an anchor, ensuring that in case my investor actually requires some money, we ensure that 30,000 rupees has been put in debt and liquid funds, which will give around 10% return. And that is something that the investor can dip into in case he requires money. Next slide. Now, one of the main important things that I saw in the economy was the fact that last year, the asset which is given the maximum return has been silver. And you have recently seen that onion prices and crude oil prices have gone through the roof. And immediately my thought was, how can I benefit from this? How can I ensure that my investor gains from this? And I looked at the fact that most of these funds invest in ETF. Now, an exchange traded fund is obviously not a mutual fund. So I stayed away from the ETF. And then I saw that in the last 6 months, the funds which I've given, and I used the Crystal website to actually gauge this. And I found that the Birla Sun has awarded equity funds which invest in these particular commodities, and the precious metal is obviously invest in these things. What is the next one? Obviously, now this is the expected rate of return. We expect 20%. This is the bare minimum rate of return which we expect from these funds. That's 2015. Right. Now we benchmark our funds against some of the world's best mutual funds. The PIMCO fund, which is the world's biggest bond fund, and has been performing exceptionally well. And we have benchmarked our funds against these. Then you have the Vanguard fund, which is managed by mutual fund manager Peter Lynch, who is a world-renowned expert on mutual funds. We go to the next slide. Now we use the magic of compounding tool to actually think about after 20 years, which is the world when we believe that our investor will require more money, which is after 20 years. We use the magic of compounding tool. Now based on conservative estimates that we only 15% we believe that the 1 lakh proposition which is given at the start of 20 years is going to grow to 30 lakh rupees at the minimum. And again, aggression, if we believe that India is going to grow at the rate at which we believe it will, 18 to 25% is the bare minimum. Now, these pictures sum up what we believe fund management is all about. It is about ensuring that the money grows. You strike a balance between aggressive and defensive sectors and spotting the right opportunities, spotting the golden egg in all of these things. And then obviously a target using all factors which can affect investment management. And that is all we have. Can you go back to the slide, the profile of investor? Yes, age is 40 years and current income is 20,000 rupees per month. And what the policy goes to value retirement? Yes, retirement. Because we have not been actually given any particular goals, there is nothing mentioned. Okay, fine, let's take out the retirement. What do you advise retirement? What does she want to retire? Based on that, she's 40 years old right now. We believe that she'll retire at the age of 60. Okay, yeah, what do you advise for her retirement? Let's say she's able to invest 10,000 rupees per month. Yes. So the thing that has been given to us is we are supposed to invest only the lump sum amount, which is 1 lakh rupees. We are not asked to go and invest 20,000 rupees per month. Okay, fine. Now what you will do with that 1 lakh rupees in one shot right now? So 60% of the amount will go into these equity funds, which is sectoral funds, diversified equity funds, mid cap and small cap funds, and the commodities or mutual funds. The rest of the amount will be invested in the debt and arbitrage funds. Okay, why is that? We believe that just in case, you can never account for the eventualities in life. You never know what is going to happen the next year. So in case she actually requires a certain amount, we do not advise her to actually take it to the equity funds. So we thought that if we keep 30,000 rupees as reserve, assuming that she needs the money, we believe that the arbitrage funds which we have chosen for her will be sufficient for her to meet those eventualities in case they happen. How much is the expected rate of return on this? Debt and arbitrage funds. Both. Or entire 1 lakh rupees. On average, we believe it is given 18%. We take the average of sectoral, the diversified, all the funds mixture, all this type of funds, and we believe that the average will come to 18%. Okay. Let's say you invest 60% in equity. Yes. And the market drops by 50% down. Yes. Senses goes to 10,000 rupees. Yes. Then how long do you want her to hold on? So we have specified that this investment should not be touched for 20 years. The equity part of it, not the debt part of it. See, the thing with equity investments is the fact that we should look at long term. We are not traders. We are not doing day trading. We are not investing in derivatives, futures, options. We are not touching any of these risky options. We believe that, I believe in the Warren Buffett school of thought. They say that, invest for the long term, invest in good companies, and believe me, the rate of return. It is Warren Buffett is an example of the fact that he invests only long term. He has never traded in his life, and despite the fact that he has never traded, he's one of the richest man in the world right now. And I believe in that school of thought as well. What any one other insight you of Warren Buffett is giving? Any one other insight? Obviously, looking at strong balance sheets. Now, the mutual funds take care of that aspect. I do not need to micromanage. All I need to look at micromanaging would be the fact that I would need to look at their balance sheets. I would need to look at the kind of fund, the management of those particular companies, the stocks. I do not need to do all that since it has been specified as only mutual funds. The mutual fund manager will take care of this aspect. What I need to do is look at the macroeconomic factors, which could be which sectors will grow. So I have actually ensured that I invest in the sectors which are poised for growth. And since this is an India-centric fund, I believe all the sectors which are mentioned will, without give us maximum returns. See, one of my friends
is a shop broker.
Yes.
He said that if I invest this 1 lakh rupees to him,
Yes.
he said that he will generate it or whatever it may be, and he will give me generate around 100% return per annum. So that means, you are talking about 20% return and maybe 100% return.
Exactly. Sir, the day trading thing is, it could go 100%, I agree. It could go down 100% as well. You could be left with zero as well. Now, we do not want to take that risk for this Samhita line, obviously. We can also invest in futures and options, those risky instruments which Bottom, Lehman Brothers, Goldman Sachs, and all these big companies. The reason they were what was, they went down was the fact that it's building futures and options. And this is the kind of risk I believe that Mr. Samhita Nair, considering the modest income, would not like to go for all this. I really we could suggest that, but the risk is too much. So we believe that
How much you studied about the history of the stock market?
I have studied since the 1800s to the 1900s for 200 years. I looked at the stock market, the global stock market, and it has been shown that the minimum return that an individual has got, even if he had invested in 1900 and he removed the amount in 2000, the minimum percentage of return was 18%. The world over, not necessarily in India in particular. If you had started in 1990 and you had gone up to 2000, you would have got 150% return. So that is the kind. When you take the global average, 18% is the bare minimum. And I have expectations very low by saying it's only 18%. It could grow by 100% as well. And I have taken this into consideration.
Yeah, thanks.
Thank you.